Hey folks, it's Henry W. Steele. Thanks for joining me today. In this video, I wanted to talk to you about moving averages, those magic moving averages. Moving averages are probably one of the most simple indicators you can apply to a chart, and the most classic way to use a moving average is for it to cross over, whether it be price crossing over the moving average like here or here, indicating selling or buying levels. Or sometimes people have, like we could add another moving average right here. And the first one I have on there is a 50 period. We can make a 200 period moving average and wait for crossovers like that. And basic idea would be when the 50 period moving average crosses below the 200 period that it's a sell signal, or if it crosses above it's a buy signal. And we can see here that, if we had consider the market a buyable market here, that we would have been for numerous months on the correct side of the market, but up here we would have been on the wrong side of the market for numerous months. And so, the classic crossover idea is okay in the very long term, but excuse me, most people don't trade that way. They might invest that way, but they don't trade that way. Plus, you can get a lot of false signals. Now, I know the basic idea is you get a couple of really good trades that make you a lot of money, and then you're stopped out on a lot more trades, but for a lot less money, and that overall, theoretically, you're supposed to make money that way. But that's a rather boring way to invest. Some people really dig it, and I guess it's okay for some people. But a lot of people who trade the market only trade over several days or maybe a few weeks or even just a few hours or a few minutes or whatever. So anyway, all that said, to say that the classic ways that you can find in all the books and all the websites to use moving averages are not the only ways that you can use a moving average. In this video I'm going to show you another way that I've never seen it anywhere before, so you've probably haven't seen it either. Odds are you haven't seen it. Okay, so first thing you have to do is set up the moving average. This, by the way, is the silver future market. It's the continuous chart here. We're going to set the moving average, this is the 200 period that I just made, to 24 periods. Okay, this is a daily chart, so we're setting it to 24 periods, and we're going to shift it 12 periods into the future. Okay, 24 period moving average shifted 12 periods into the future. It's a simple moving average, and it's all applied to the close. There we go, right there. Now here's what I'm going to show you. If you'll put a horizontal line on the chart at important price points, like $20 is an important price point here. I'll put another one on. 1750 would be a psychologically pretty important price point, right? Okay, so what we're looking for is the moving average to cross over these points in time, or these points in price, I'm sorry. And it creates a point in time where you can expect the general trend of the market to change. So if it's been going sideways like it had been here, we see that after it hits this point, or after the moving average crosses over the $20 line, the market comes back down. It changes trend type. Up here we see that we had the market moving down, and it crosses this line and it stops and it starts to go sideways and eventually heads back up. We see right here that when it crossed the 1750 we stopped going sideways and we started going down. And right here we had a little hiccup where it was at the bottom right there. The market moved up pretty strongly, and then when it crosses again it stops and it starts going sideways again. When the moving average gets down over here, we see the market had been moving down strongly. It stops and then it goes sideways basically for a few weeks there before it starts meandering back up. Right here we're off by about a day right there from where the moving average. We were at the very top and the market moved down there. And then we see right here that the moving average has crossed just as of Friday the 26th of May 2017, we're at what looks like is probably going to be a top here. So at this point, I would expect the market to start moving sideways or back down. So you probably get the basic idea here. When the moving average crosses one of these important price levels, we can expect the market to change whatever it was doing before. Now, this isn't, a standalone system or anything like that, and it's not always exactly precise, but it kind of gives you a heads up of what might be coming. I'm going to look at my list here. Tesla. I like Tesla. We're going to look at Tesla. You can see I got a moving average on Tesla already, and it is that same 24 period moving average, shifted 12 periods, applied to the close, and it's a simple moving average. Let's put some price levels on this chart. 200 would definitely be a psychologically important level, right? 250 would be another one. And we see that, go all the way back in history. If we look here, we see that back here in 2014, let me scroll back here, is the first time that the market actually got up to this level. And we see that the market came down, was doing sideways action right there, and then after the moving average crossed over there, the market came down like that. Here we see that the market was a little hiccup right here, and then it just kind of hovered right around the $200 price level right there. So that's kind of not a false signal, but a mixed signal. When it starts, it's at the bottom right here, and when it ends, it's at the top right there. So you could consider it, you could look at it that way. But here's one where we have the market moves down strongly, touches that right there, and then bounces off of it. Here we have a situation where the market's been moving up, kind of a choppy, let me zoom in here, choppy moving up, gets to the little top right here, and then comes right back down right there. Here we have the market going sideways, and then right there it shoots up like that. Here we have the market moving sideways again. When the moving average crosses that $200 price level, then we start to trade up again like that. We get up here to the $250 price level, and we're right there at that top. Right here we're in a contracting triangle right there. The moving average crosses that important price level and then breaks out from there. Here at this point in time, we're at the bottom. The market stops moving down, and it gives a little hiccup back up. Here, right there, we're at, I guess, the bottom of this, really. Yeah, I would consider this, I don't know, what is that, the halfway point failure of a sideways market? Sounds good to me. Here we have the market moving up rather strongly, and then at this point in time, we have I would call that a failure too, because the market, I mean, there's a little one-day hiccup there, but it's nothing tradable really, unless you're intraday. But still, this method isn't really just completely precise, meaning don't expect the exact day that it happens to have a perfect high or a perfect low. What you're looking at is you're being forewarned, so to speak, that there's a change in market type. And right here we could see that it's pretty much a failure, but it happens pretty close to the halfway point or the 1/3 point. So that would definitely be a failure. Right up here we see that the market has made a top right there, and then it comes down and goes sideways for quite a while. We don't quite get to that price level right there, so that one's no good. This one right here, we're at bottom sideways action, and when it crosses over we start back up momentarily. Excuse me. Here we're having, the market's moving up strongly for a month and a half, 2 months right there. We get to this point, and just a couple days later we're done moving up for a week and a half or so of consolidation right there. We see the moving average crosses over the 250 level right there. We see what happens. Let's see, let's move this line up to the $300 level right there. That's a $300 level. We're just a couple days after the top there, and we move down. Anyway, let me go to coffee. Coffee was another one I wanted to show you. And again, the continuous chart here. 150 is quite obviously a psychologically very important price level. We crossed it right here. When we crossed it, we went at this bottom point right here. We were 1 day off of it right there. The market moved up pretty significantly. Right here we crossed it, and we were at this consolidation zone right here at the top, and then the next day we break down into a lower area. Right here we had been moving up, and then we hit the consolidation area right there. And right here we were a day away from the end of the consolidation area and the market moving back up. Right here we're right at the top. The market was moving sideways, popped up, hit that, and then moved back down. The video is already getting pretty long, but I'm pretty sure you get the basic idea here. But there's one important thing that I wanted to tell you, and hopefully you're still watching after these 11 minutes. Because if you're not, then you're not going to get this important information, and that is the 24-period moving average works in some markets. For instance, the markets I've showed you, silver, Tesla, and coffee, it definitely does do a fairly good job on. You're going to find that there are other markets where it does not work as well, and it's not because this doesn't work, it's because the 24-period moving average is not the moving average that you need to use in those particular markets. So you are going to need to farm the markets or test the markets to see which moving average seems to work the best for you. So when you do that, what you want to do is make sure that whatever period you're trying, shift it 50% of that period into the future. Now, the reason you want to do this is because it pushes the moving average kind of back into phase, so to speak. And there's some mathematics behind that I won't get into. But it basically pushes it back into phase theoretically, and it also gives it a predictive quality. In other words, in this particular instance, because the moving average is 24 periods and it's pushed halfway into the future, it has 12 periods into the future that it's printing before the actual market. So this cross here, all these crosses happened before the market ever got to it. So you have plenty of time, 12 days in this particular instance, to be forewarned about what's going on. So anyway, I hope you found this interesting. Another possible tool to add to your toolbox in trading. And I'll talk to you later in the next video.